Hi guys, welcome to another video. So in this video we are going to discuss about the introduction for finance and investment banking, the part second of the video. So let's start. So this will be gonna about the 5 to 6 minutes. Let's start. So the first question: how long does it usually take for a company to collect its account receivable balance? Like what is the it's a technical question like some and but it's simple meaning is that like what is the average period of the account for a typical company, like that is the simple stage. So that is so the generally account receivable days are 30 to 60 days, the average. Though it's higher for the company selling the high end item. Like it is higher for the those companies like who are selling the high end high value item, and it might be lower for the smaller lower transaction value. Like let's say if a trade receivable is just for the 10,000 rupees, but if a trade receivables for the 10,000 crore rupees, so that's a very big. So in that case, the balance may be balance transaction, so time may be vary with the time to time. So, but you can say that you can also put this example as that will give you a better impact on the scenario. Next, what is the statement of shareholders' equity and why do we? So the statement show everything we want to about the major items that comprise the shareholders. Like the shareholders' equity include the older items related to the equity transactions, the shareholders, and why we do use it. Like we use it for the our analysis purpose, and that define like everything is going fair. So how we arrive at the each of them is the numbers elsewhere in the statement. Like we have to calculate the each number, like how this will arrive. We don't use it too much, but it can be helpful for analyzing. Like it will be better, it will be helpful while we make the analysis of the company. So statement of the equity include the all the share capital transaction, retained earnings, and apart from that current account transactions as well that related to the business. So you can go for that. And apart from that, there is also include the unusual stock-based compensations and the stock option situations as that the part of business and that are under the transactions of the market. So that will be a better hypothetical analysis. Next one is how should you project the depreciation, the capital expenditure? So simple way to project like as a each one as a percentage of revenue, the previous year balance, like as we use in the industry, like as a percentage of revenue, the previous PPE balance. And apart from that, there's a major complex way like create a PPE schedule. We generally use in the financial, like we create a PPE schedule, and that we split the different assets by their useful life. Like there's an asset who's have the 10 years of the useful life. So we'll calculate this by the straight line method. And apart from that, we can use the WDV as well. That depend on the over the each asset useful life, and then we assume the capital expenditure based on the what the company has invested historically. So we can add the CWIP in that because that's a part of the asset, and we can also put the depreciation, but that also define on the timeline of the business, and that also define the timeline of the assets and nature of assets. So this will be another situation for the market hypothesis and market scenario that are making the things as per hypothetical scenario. So let's start with another important that capitalism. Apart from that, just a minute. Yeah. Why do you look at the both enterprise and the equity value? I'm assuming that you all know about the what is the enterprise value. So enterprise value, firm value, terminal value is equal to the value of the company that is attributed to the all the investors. Like it's a total value of company today, total net worth of the total value of company that is attributed for the all the investors, whether these are the equity or whether these are the debt investors that is available to all the shareholders. For the equity value is represented. It's suggested by name like equity. So it represent only the equity shareholders. And you look at the both, like equity value is the number at the public at large see, while the enterprise value is the, so these are the two different things, the business. But enterprise value is something that is related to the business, and that is in the all the values, like whether it's debt transactions or whether it's the equity transaction. But the equity value is related to equities only, that only compensate the equity transactions. So this is the difference between the two. If you like that, you can like the video and subscribe the channel. Let's let's meet in the next.